Hello and welcome to this very special Money Week webinar. I am Merryn, web editor-in-chief of the magazine, and with me today I have Jim Mellon, a very old friend of mine and an old friend of the magazine. He's a fund manager, an investor, a longevity expert, a dog lover. Jim, welcome. Thank you for joining us.
Hi Merryn, it's lovely to see you. Happy birthday. Happy birthday. I've got some tea here to celebrate.
Thank you very much. Now, shall I tell you what? I have in front of me the first ever issue of Money Week. And you wrote the first ever personal view in this magazine. And I'm going to read you a little bit of it because you will be amazed at quite how brilliant you are. Ready?
Sure.
Okay, here we are. And the date is 4th of November, 2000. I've just spent a month in Silicon Valley, and I can honestly say that this area is now the epicenter of the economic universe. It is home to intellectual property and technology production on a scale unequaled anywhere else, and to all the world's leading venture capitalists. A golden age of invention and progress in life sciences, information and technology is ahead of us. How right you were, right? But you also, in this piece, you tipped one stock, okay? Ready?
I know which one it was.
One company that I think has a disruptive technology, albeit in a mundane sounding field, is Align Technologies. They have taken the old dental brace and transformed it into something that is invisible, easy to wear and cheap. They will control a multi-billion-dollar marketplace and will prove an excellent investment. Do you know how much the shares have gone up since they listed just a couple of weeks after you wrote that?
No.
2,500%.
Wow. I can tell you a few ones that haven't gone up that much.
Well, so can I, but I wasn't going to dwell on those today.
We're celebrating.
Any reader who read that first issue and bought this stock as soon as it was available, which is at around $16, they are now $457 each. And that is up from $350 odd in the last couple of days because they just announced amazing results. So fantastic. And the second thing I want to pull out from this article, and this is not, a total sucky up interview, but the next bit is also very good. You're talking about NASDAQ and how much it's fallen and where it might go. NASDAQ index as of 31st of October, remember we're still in 2000, was at around 3,200. I think it could sputter down to 2,500. At that point, things will look very interesting. But of course, it went down further. It went down to about 1,100. But had you bought then at 2,500, whatever, it is now 11,500. So some fairly impressive change there. And I bet there's an awful lot of Money Week readers sitting there now, really wishing that they'd had issue number 1 and done what they were told by you, if not by me. I think I was writing. Although actually, I say that, I wrote about property prices in the beginning of this, which when people look back at it, slightly blows their mind, saying that one should buy domestic residential property in the UK. So there you go. And what a long 20 years it has been. So what I want to do over the next, I think we've got 25 minutes, is talk about these amazing trends that we've lived through over the last 20 years, but then in particular talk about what we might expect from the next 20. So the last 20 have been characterized by this extraordinary bond bull market, by interest rates falling and falling, by a background of, if not deflation, at least not particularly inflation, by globalization, by the rise of China, and of course the last decade has been dominated by the global financial crisis. And what we think at Money Week, when we look at what's going on around us now, is that this year feels like something of an inflection point. The point when a lot of those things might begin to change, and we might start to look at a whole host of new trends that will take us through the next 20 years. What do you think?
Well, I completely agree with that. I mean, I think we are on the cusp, or in the middle at least, of one of them, but on the cusp of major revolutions in 3 distinct meta-thematics. One, as you know, I'm very keen on, is longevity. The second is the agrarian revolution, for want of a better word, Merryn, or phrase. And then the last one is the environment, which, especially if Biden wins, which looks very likely, will be a very major focus of investment. Although I think the investment opportunities there have to be looked at very carefully indeed, because the yields and opportunities there are being very compressed. And those 3 will be sufficient to carry investors forward from a stock point of view, I think, over the next 10, 20 years. I mean, God knows how old I'll be by the time you're 40 on your 40th anniversary. I'm still around.
Well, let's talk about that. Let's start with talking about longevity, because this, possibly for you and I, is the most interesting bit, right? Will I still be able to edit Money Week when I'm 100?
Oh, I'm sure that's absolutely possible. Whether you want to or not is another matter. And what form Money Week will take will be very interesting. But absolutely, you'll be completely compos mentis, and you'll be robust, and you'll probably have another 10 or 20 years ahead of you. And the reason for that is that the diseases of aging that cause frailty are being addressed pretty rapidly, actually. And the one disease everyone's very concerned about, which is Alzheimer's, stroke, dementia, I think there'll be prophylactic treatments available quite soon, which will stop you from getting the buildup of plaques and tau protein tangles, and will allow you to avoid Alzheimer's, even if you're familially or genetically predisposed towards it. So yeah, you'll be absolutely fine. You'll be with your editor's visor on, doing your scribing when you're 100. I mean, that's about
60 years
nearly
old.
60 years. Yeah, I think 60 years away. It's a long, long time. I mean, I think I'll be in my box by then, or I've been burnt. So, yeah.
What are the really interesting companies working in this area?
In longevity, there's very little that you can publicly invest in. We have our own company, Juvenescence, which obviously we regard very highly. And there are 2 or 3 other companies. There's Google's Calico, which is a joint venture with AbbVie, that seems to have some interesting stuff going on, but no one really knows what the detail is. There have been 2 failures. One is Unity Biotech, and the other one is Restore Bio, which were American public companies. And Regeneron has recently hired a guy who's really interested in aging. And Regeneron's a huge American biopharma company, and I think they'll do great stuff in aging. But whether it makes a big dent in their profits, I don't know, because it'll be diluted by just the sheer scale of the company. I think you have to watch out for public offerings. I mean, it's now announced that Juvenescence is going to try and go public in the next few months, and we'll certainly try and do that. That will be one to look at.
In the UK, Jim?
No, in the US.
US.
Yeah, via SPAC. So Credit Suisse are working on that one, and we'll see if that works out. But there's very little public stuff that you can invest in. There are a few private companies, and there's a couple of funds. The Longevity Vision Fund, run by Sergey Young, it's a great name for an anti-aging company. Is a good fund. He's got a good dispersal of assets, but I think you have to have significant money to go into his fund. So, but he's based in London. It's a nascent field. It's like the dial-up phase of the internet, and I don't think there was anything you can invest in really in that early stage of the internet, apart from Netscape in those days. And now it dominates and is intricately woven into every aspect of our lives, which will be the very interesting, I think, change in the next 20 years, is what happens to the internet. What becomes of the internet? What becomes of all those companies that have done so well in the last 10, 15 years? And I think that's really the key issue for our times.
The big tech stocks in the US.
Yeah, I mean, they're very fully valued. They're under assault from regulators. They are, for all sorts of reasons, not just privacy and lack of what's the right way of putting it, lack of scrutiny issues, but also because of their monopolistic tendencies. Yeah. And I think that will be a very interesting debate. At the moment, they're making monopoly profits, but how long that can go on for is another matter. I think they will be under severe pressure in a Biden administration.
They might.
I mean, they're certainly not investable at the moment, I would say.
I'd give you that they're not investable, but it's very hard. Maybe I lack in imagination, but it's very hard to see how they stop being such a huge part of our lives. I mean, I can't imagine not using Amazon and Google and all these companies that are so completely intertwined, and particularly post-lockdown, into how we live.
Yeah, that's a very good point. I mean, looking at Amazon, however, though, in this period of the pandemic, Amazon's lost retail market share to Walmart. and to Best Buy in the United States. And Walmart has been growing incredibly quickly with its offerings, because if you think about it, Walmart has, I don't know how many thousands of stores around the US. And you can just drive to your nearest Walmart, and I think 95% of the population of the US is within 10 miles of a Walmart or some stat like that, and pick up any goods that you order in the morning. So it's even more convenient in that respect than Amazon, and they're a very smart company, Walmart. So Amazon, which depends on its cloud computing business for its profits and its cash flow, basically, may find itself under some pressure. So my view is that, I mean, I've said this, I've been too early on this, but my view is that these are not investable stocks. I think if you've been lucky enough to have them, you can see them tipping over at the moment. You can see interest in the United States market moving away from the tech stocks to the cyclical areas, quite rightly, in my opinion. And I would just, I would let them go. I don't know about Apple, because Apple's about 30 times earnings, but it just keeps on making more and more money, and people seem to flock to its products, but it's not under the same scrutiny and regulatory pressure as the other ones are. So I'd just be very wary about these companies. And I would absolutely avoid Tesla. I think that the big car companies are now producing really good electric vehicles, and they're going to give Tesla a really good run for its money. And whereas the software companies, the FANG companies, which are basically internet-based platforms, don't have to make anything, Tesla actually has to make things. It has to buy raw materials and have production lines and so forth. So its margins are always going to be much lower than those of the software companies. But it's valued as if it was itself a huge software company.
Yeah, and its operational risk is so much higher than those other companies. Okay, so when you say that you're moving into cyclical investments in the US, what is it that you mean by that?
Well, I think I know as much about the pandemic as anyone else, and probably even less,
Lord.
or maybe not as little as the government's advisors seem to know. But I would say that we're not very far off either a vaccination or the pandemic burning out, and we shouldn't all be scared and in constant lockdown. And if that's the case, then what will people want to do first thing out of the gate when we know the pandemic's gone? And by the way, the last big pandemic was from 1918 to the year 2000. Sorry, not 1920, not 2000. And when it burnt out, we had the Roaring Twenties, or they had the Roaring Twenties. And so I would say that people will want to go traveling again, and they'll want to go to pubs and restaurants and all that sort of stuff. And those businesses are valued, the best quality ones are valued as if they were about to go bust, and they're not. So my recommendations is IAG Group in the UK, Delta Airlines in the United States, by far the best US airline. And then in the UK, you could buy any one of the pub companies. So the one I've been buying is Marston's, which is got about 1,400 pubs and has recently done a joint venture on its brewery business with Carlsberg. Yeah. So these things are highly leveraged to a cyclical upturn, and I think they'll do much better than the tech stocks as we get out of this period.
Yeah, they might also find that there's slightly less competition in their areas than there used to be, and because the
very good point
will go bust, so they may see margin expansion over the next couple of years as well.
That's a really good point. And if you look at IAG, which owns BA among others, as you know, they have not taken any government money in quite deliberately because they want to have their rivals go bust. And I think the two that are in their particular sites are Norwegian Air Shuttle and EasyJet, and they want them to go bankrupt so that they can get more slots, more domination of the market, etc. It's normal business practice, I would say.
Yeah, interesting. Now, UK stocks in particular have done appallingly over the last few years, and basically since the Brexit vote. And so there is this overlay of COVID, overlay of government incompetence, but on top of that, from the point of view of foreign investors, a massive overlay of Brexit uncertainty. Your foreign investors left a few years ago in volume, and they haven't come back yet. But there is a sense, or I'm beginning to get a sense anyway, that they will come back whichever way Brexit goes at this point, whether it's a deal or not a deal. All anyone requires is some kind of certainty. Markets always say that they hate uncertainty. So I'm beginning to feel there may be a catalyst in Brexit, whatever the result is, as long as there's just a result.
I completely agree with that, Merryn. I think the major signal for me to be bullish the UK was today, when Anatol Kaletsky, who I have to say, and I pay for his service because he is always wrong. And when you're always wrong, you can take the opposite side of the argument. He came out and said that British assets were going to be trashed, and this was a disaster, and blah blah blah, which he said before, but not as vehemently as this. And one has to think, P ratios of UK companies, and bearing in mind that the FTSE 100 derives 75% of its earning or its revenues from overseas, so they're not really British exposed companies to a large extent. The FTSE 100 is incredibly cheap compared to the US or to, well, really any other market that you care to point at. Maybe Germany is quite cheap as well. But I think it's true that Apple's market valuation is bigger than that of the whole FTSE 250. I mean, that reminds me, and it reminds you as well, of Japan in the late 1980s when supposedly the Imperial Palace was worth than the whole of California. So we're in that sort of stupid territory at the moment.
Interesting. Okay, let's have a look at the other two big trends that you've been talking about. One is this, the agrarian theme, the idea that, we're talking about vegetable proteins, right? Meat replacement products, which you're really interested in. Is that what you're talking about? I
am, not just meat, but also materials and other forms of food, including seafood. So the pandemic has come out of agricultural malpractice in, let's face it, in China. We know that. We have to do something about the food supply for all sorts of reasons. One is the Chinese and the Indians want more meat-derived protein, and the production of that protein has to be very intensive. And apart from animal cruelty issues, which concerns me, but not very many other people, the environmental impact of this is disastrous. So put it in perspective, after the Second World War, there was almost no intensive farming in the United States. By intensive farming, I mean animals reared such that they don't see anything other than the shed they're reared in, or are grown on feedlots. And today it's 99% of all meat production in the United States. That absorbs vast amounts of plants that are grown specifically to feed animals. And the reason that the Brazilian rainforest is being cut down is to grow soybeans to feed to animals. So 75% of all plants are grown in order to feed animals, not to feed us. And two things have happened fortuitously. One is that the plant-based products have got a lot better. So Beyond Meat, as you know, and Impossible Burger, and in the UK, the Meatless Farm and Corn are much better than their products are much better than vegetarian products, say 20 years ago, are quite palatable actually, and we eat them in this household, the Beyond Meat burgers. And the second is that at the same time, lab techniques to grow food have become much improved. And already most of the 60 companies or so in the world that are growing food or materials, and materials I mean cotton or leather or threads, in a laboratory, have got samples that you can actually taste or you can see and feel. And so it will be a very short space of time that we'll see these products widely dispersed. And so in the lockdown, I've been writing my book, and I'm not doing it as a plug, but I'm telling you that my book is called Moore's Law, because it's a riff off Moore's Law, which we're all familiar with. And as the scale and the cost of this stuff, the scale rises and the cost comes down, this is going to be a very disruptive factor. Now, all you have to do is look at the alternative milk market. So these are milks made with soya or almond or oat or whatever. 10 years ago in the US, it was about 0.5% of the market. Now it's 20% of the market. The two biggest milk producers, conventional cow milk producers in the US, have recently gone bankrupt. And you're now seeing fermented or cell-related milks coming onto the market. So Perfect Day has raised a huge amount of money. Notco has raised a large amount of money. Impossible is going into the milk market as well. And it won't be very long before you see 50% of the US market being a dairy market being alternatives, and the same for cheese. And then following behind that is seafood, which is easier to get to market than meat. And following behind that is meat. And so the market opportunity is absolutely incredible. And there's another stupid phrase that I use in my book, which is called griddle parity. And everyone who reads Money Week knows about grid parity, when the price of electricity created by renewables comes down below the price created by fossil fuels or conventional methods. Griddle parity is the same for food, for meats. And we're within about 2 years of griddle parity for plant-based meats and about 5 years for lab-grown meat. So this will constitute an enormous revolution, and it gives the UK in particular a big opportunity, because we import half of our food. We would release a lot of land if we didn't have to grow all these plants to feed animals. And I know that you have a farming interest, and obviously farming will be for organic purposes or very high quality purposes will carry on. But this intensive stuff has got to stop, because you know, the pandemic threat from the antibiotic use, the hormone use, and so forth is enormous. So we need clean foods to come out of labs and to come out of plants, and that's happening fortuitously.
Interesting, but it gives the UK two advantages or opportunities, should we say, this one that you're talking about, but on the other hand, also because there is in the UK an awful lot of cleanly raised, pasture-fed protein. So, you know, our sheep farming and a lot of our beef farming is very pasture-led, not fed from crops grown elsewhere, et cetera, et cetera. So there may be a post-Brexit opportunity for the UK to establish itself as a premium protein producer.
Yes, I don't disagree with that. This is not going to be a complete replacement of conventional agriculture, but it's going to be a solution to the demands of especially developing countries for more animal-based protein, and to the incredible environmental impact of these things. Because I don't know if you know that the animal husbandry creates more emissions than any other thing on Earth, any other man-made form of enterprise on Earth. It's about 18% altogether. So reducing that would have a very positive impact, you know, and should please people like Greta Thunberg and her disciples, because it's the way to go. Really, it is. It ticks almost every box.
Yeah. Well, that leads us neatly into the third trend that we're talking about, the environment going forward. So, you know, we're about to see, aren't we, an explosion in announcements of new green deals across the world as part of the fiscal stimulus that government's going to want to put in place to bring us out of the pandemic.
Yeah, and yours and my friend James Ferguson thinks that this is a massively unproductive use of money and human capital, and he may be right in some ways. But it is the case that the UK has, I think, done more in renewable energy almost than any other country apart from tiddlers like Denmark. And speaking as someone who, as you know, lives in Ibiza some of the time, and we've got solar power here and it works very well, I'm a believer in it.
It might not work so well in Scotland, Jim. That's all.
What? It might not work so well in Scotland, but you've got offshore wind. You've got huge amounts. So battery technology is really important, because obviously there's no point having all this wind power if it can't be stored for use when the wind isn't blowing or whatever. And so there's a lot of like moving parts here. But what I would say is, if I'm very interested now, so I'm actually going to get my colleagues and I are going to sit down virtually and talk about hydrogen, because I have a sneaking feeling that hydrogen might just displace all this mania for electric vehicles, and especially for trucks and for heavy transportation. And hydrogen is much cleaner in every way than electric vehicles and electric powered transportation. And the reason is because it uses, the electric stuff uses so much minerals and energy to produce it in the first place. Yeah. So I'm going to do a deep dive onto hydrogen stuff, and I'll let you know about that when I've completed my investigations. But for now, we've got quite a lot to go on. We've got cyclical stocks. We've got your favorite in Japan, which I absolutely applaud. And I've been buying up Japanese funds. I can't remember which ones, but I've been buying a few of them. And then we've got the longevity stuff, which keep an eye out, because it could be a very big industry, could displace a lot of stuff in the pharmaceutical industry. And of course, we've got the clean meat space. And so there's just a tremendous amount of optimistic stuff out there for us to get our teeth into in the next 20 years of your magazine's existence.
What about, the last question, what about the Chinese market? I mean, that's, you know, China is the first country to have come out of the pandemic. Growth seems to be back to normal on the demand side, back to normal on the supply side. And the market there, of course, has had a very good year. Is that somewhere you're invested at all?
Only in a limited way. So I would say that Alibaba is a great company to invest in. The new Ant Financial in Hong Kong, which is its kind of spin-off, is a great company to invest in. Chinese tech seems to be cheaper than US tech and yet has a bigger opportunity. In terms of anything else, I don't know enough about it. I think it's very speculative. But fortunes will be made in China, but they probably won't be made by me. And getting back to what you said at the beginning, aligned technology. So I invested in aligned technology and I sold it far too early, which is unfortunately the way of the world. So but it was a good investment.
It was. Well, I wish I bought it. But of course, compliance, etc.
Well, can I just give you one Money a Week readers, one final tip, if I may, Merryn? I've been hoovering up. I mean, I'm never going to dent the share register in a way that's declarable because it's too big. But I've been buying Lloyds Bank shares. And in my view, Lloyds Bank has a lamentable management. And why the board wasn't all fired after the various scandals, I've got no idea. But it is a dominant factor in our retail banking. And knowing something about banking as I do now, I think Lloyds could have a really good sling back. And it's probably on a 7 or 8% prospective dividend yield for next year. It's at a fraction of its book value. It's never going to go, well, I say never, but it's very unlikely to go bust. And it will reflect everything that you just said eloquently about the potential recovery for the UK economy and the aberration for UK assets over the next 2 or 3 years that will happen from foreigners. So I would buy Lloyds by the bucketful at the moment.
Okay, Jim. Well, I'll tell you what, I will come back to you in 20 years when we will both still be young and we
Absolutely.
will see if that has gone up by 2,500%, like your first tip from 20 years ago. Thank you so much for joining us and for being such a good friend of the magazine.